Should you invest different before retirement versus when you are in retirement? Well, if you want to know what the difference is and how it works, listen to this episode. We give all the details.
We hope you've been enjoying all the episodes from Secure Your Retirement. If you'd like to keep learning and receiving these episodes, hit the subscribe button and the bell so you receive alerts when they come out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
Welcome to Secure Your Retirement Podcast. Merce and I are very happy to take some time to talk to you about a very, very important topic today. And the episode here today is really talking about investing before retirement and then during retirement and the differences between that. And here's kind of the thought process behind it is when I'm younger, and I'm in a growth mode, and I can withstand letting my money just sit and grow, and I could actually have markets that maybe are volatile. Doesn't bother me. In fact, if you're listening to this today, and let's say that you're 60, maybe 65, and you think back to the last time that you saw major downturn in the market, that would take you back to 2008. Well, you were quite a bit younger in 2008, so you were probably working, feeding your 401k. And whenever that market turned down, which, by the way, from the top to the bottom fell 58%, you probably were maybe concerned or perplexed, but you're like, I got plenty of time left to work. I'm just going to keep feeding it. And if you did what you should have done back then, you probably fed it even more because the market was so low. And so you just put more money in because you knew you had a long time horizon. Now, if today you are 60, 65, and you had that same scenario happen, the stress level on that is going to be very, very different. Why? Well, because if you lose 50% of your money now, you don't have those decades to make it back. And it's quite detrimental. In fact, we talk about this a lot when we're talking to our clients. If I've got $100,000 and I lose 50%, how much money do I have? Well, if you're doing that math with me real quick, it means you've got $50,000. Now, if the next year the market did a gangbuster year and made 50%, are you back to a break even? And the answer is no. You're at 75,000. So when you lose money at the rate of, let's just call it 50%, I have to make 100% rate of return to make it back to a break even. Not as big a deal if I'm younger and working and feeding, but if I am closer to or in retirement, that's a really big deal. So we have to really think about risk in a different perspective than we would when we were in our 40s or 30s or something like that. So what we really are talking about today is what type of things do I need to think about? What types of shifts do I need to make as I get closer to or in retirement? It doesn't mean we're going to get out of growth. It doesn't mean we're going to stop trying to grow our money, but we might have a different approach in saying, how much downside risk am I really wanting to be exposed to? And that's really the conversation today. So, Merce, I think what we wanted to do is kind of hop over to your side and kind of talk about the two different phases specifically when it came to this idea of before and during retirement.
Yeah, so two distinct phases that are talked about quite a bit in our industry, which is pre-retirement and then post-retirement. And what are the things that you do when it comes to retirement planning, or really in this case, investing in pre-retirement versus post-retirement? So, think of pre-retirement. That is your another way to look at it is your accumulation phase. That is, you're doing everything you can to sock away money for this distant ideal of retirement down the road. And hopefully you start early, and you're starting to save in your 20s and 30s and saving even better into your 40s and 50s. And you really get the power of compounding growth on the money that goes into those accounts. And 401ks, IRAs, 457s, 403bs, the list goes on and on of these pre-tax types of retirement accounts. To me, in a way, they're just a big funding vehicle with some benefits to them. Think about the 401k. The more you put in there, the more it's going to reduce your tax bill for the year if you're using a traditional 401k. And so, and it has its own tax things that we have to think about down the road, but it becomes a massive incentive to put money in there so that we reduce our tax bill. But it's really a funding vehicle for retirement, just like an IRA is or any other retirement-based account. And so, like Raiden was saying, in our younger years, as we are trying to accumulate wealth, we can handle some of those ebbs and flows of the market a lot better because we know we've got time ahead of us. And the phrase of like, think about the 2008 of buying the dip is a real possibility because we are working and earning, and there are times where we have the cash on hand available to make that decision to say, hey, the market's down 10, 15, 50%. Let me dump some more money in there because I know I've got time to really benefit from that. That changes a little bit when we get into post retirement or no longer accumulation. We're no longer working, earning, and saving. Now we are still, now we are really spending that money. And that's a bit of a hurdle for people, in some of the meetings that we run, financial plan strategy meetings, and kind of walking through the financial plan and showing that this year, based off of the numbers, you're going to have to withdraw, 30, 40, $50,000 out of the portfolio. It can be a little bit nerve wracking to say, how is that possible? And how is that run rate going to be okay for the next 30 some odd years? And so that's the distribution or the deaccumulation phase of your life where you're no longer earning, you're living off of what you have or what you've done to prepare for retirement. So in most cases, for most people, it's going to be you've got Social Security as a fixed income. Some of you may have a pension, but then it's really your investments, whether that's the 401ks, the IRAs that you've built up, maybe a brokerage account as well, cash in the bank. Maybe you've got some rental properties that are income generating, but that's all. What have I done to prepare for retirement? And so thinking that through, and here's the key. I think sometimes the industry just says when you retire, you need to be very conservative. We don't agree with that. We think that there are ways that you should invest your money in different types of risk factors and different types of ways so that we pick up diversification. But in no way are we saying that, hey, we need to stop growing. Absolutely. We need to continue growing the money, growing that bucket as best as possible within reason and within the risk that you're willing to handle. But the distribution phase is very important, and getting that set up properly is really what's going to lead to, that comfort and that reliability and that peace of mind when it comes to retirement. So those are the two. Build that wealth and then eventually start spending it down. And then maybe we leave some behind to our heirs as well. So, Braden, let's talk a little bit about, goals people have when it comes to the pre-retirement side of it and then during retirement and things that we hear all the time from clients.
Yeah, I mean, if you think about it, if you're still working and maybe now let's talk about maybe your 50s and you're still working, the goals usually at this phase are still the same. I mean, you're trying to max fund your 401k. You're doing the catch up on the 401k. You're trying to sock away as much money as you can. You're probably still growth oriented in your portfolio because you've got another decade really of work, or decade and a half. And so you might be starting to think about risk a little bit, but really you still got enough time to say, no, we're gonna fund this 401k as much as we can. We're gonna grow it as fast as we can. So we're willing to take a little bit of risk because we've got that time. And that's all great. That's all wonderful. Now, as I get into retirement, a couple of things change. When I get to retirement, I'm no longer working. I'm not going to be max funding the 401k. So that's not going to happen. I'm going to start to think about preserving my wealth. I usually say to people, our typical client, our statistical client, if you want to take it, they say this: I would like to make a decent rate of return and not lose a bunch of money. And that is exactly what our infrastructure is to say, how can we avoid major losses? Now, we'll talk about this a little bit more, and we have a whole episode on this particular topic, but one of the ways we do this is with a 3-bucket strategy. Bucket number 1 is my cash. Bucket number 2 is my income and safety bucket. And then bucket number 3 is still my growth bucket. So the only thing I did is, instead of just leaving everything in the growth bucket, I moved some over into my income safety bucket, because now in retirement, I'm going to need some safety and I'm going to need some income. So if I've got enough money coming in on my income safety bucket, I can allow some volatility on my growth bucket. It just keeps the emotional roller coaster out of our head, right? So we're not that worried. Another thing that we have to think about during retirement are required minimum distributions. Now, that for most people, if you are in your 50s or early 60s right now, that's going to be age 75. So you've got some time, and that gives you time to start planning And some of the things you might want to start thinking about there is, how do I get money from a tax deferred scenario to a tax free scenario? Again, kind of a part of this whole investment strategy of what I want to make sure I think through. I also want to think about, where do I want to take money from? For decades and decades, I worked and I saved money, and now I'm going to be in retirement. And so now I've got to start taking money. Do I take that from my Roth IRA? Do I take it from my traditional IRA? Do I take it from my individual or joint account? Do I take it from the bank? Well, there are good strategies to think about when it comes to that. And one of the things that we provide for our clients are income strategies. What is the best way to take income to make ourselves tax efficient, to deal with risk? So those are all things that you got to think through when it comes to this, the daring retirement element of things. Now, there is the investment side, and we want to talk a little bit more about that. We'll kind of talk a little bit more about the buckets as well, but we've got two topics we want to kind of move into here really is risk management and then allocation, really between those buckets.
Mm-hmm. Yep. So let's talk about the phrase asset allocation. That's a term that's used a lot in our world, and so but it can mean a bunch of different things. But in general, it's saying, how are we distributing the assets in our portfolio, right? So a simple way to look at it, the most commonly known model portfolio is that 60-40 asset allocation, 60% towards equities, 40% towards bonds or fixed income. And that's been one of the more popular ones. That one has actually had a lot of issues here really since 2020 up until, today, with where rates are and everything like that in the interest rate side and bonds and the uncertainty around all that. But 60-40, that's an asset allocation, or you could have a 50-50, right? If you're in your pre-retirement stages of, say, you're in your 20s to 50s, there is no one size fits all, but in most cases, you're going to be a little bit equity heavy because you really want that growth, and you can handle the risk of the growth because you've got time ahead of you, right? If you're in your 20s, you're probably not planning on retiring until you're in your 60s. So you got 40 years of growth and volatility that you can handle. And the rule of thumb is, as you get closer to retirement, you should be reducing your equity exposure and increasing your safe exposure, your fixed income type of exposure. Again, that's a rule of thumb. We have clients that are, in their 70s and 80s that are a little bit more aggressive than some of our clients that are in their early 50s, right? So a bit of this is your appetite for risk and how you approach it. But that's really the idea, is as we are younger and we have time on our sides and earning and savings capability, we can be a little bit heavier on the equity side. As we get closer into retirement, 5 years out, 3 years out, there is a natural shift that happens in our own side, in our own behavioral side of things of, man, I've kind of got what I've got at this point. Yeah, I'll save a little bit more over the next few years, but this is it. And I do want to retire and I do want to make this work. So our behavior starts to tell us that we need to have a shift in an overall investment strategy, and it's really having a plan in place so that when it comes time for retirement, we know exactly the buckets that we're going to be drawing off of. We know what our exposure there is and everything like that. So we fully believe in, when it comes time for retirement and setting up an income plan, like Graydon said, the buckets work really well. One, because it provides predictability. There's this thing called sequence of returns risk. So imagine all your money is in the stock market and you retire, and then we walk into a 2008 type scenario, or even a more recently here, a 2022 type scenario where the markets were down 20 to 30%. All your money is exposed to that. But also on top of that, you need $5,000 a month out of that portfolio. So the market is losing money, which means your portfolio is probably dropping, as well as we are drawing on that money at the same time. That is a scenario where it makes it really hard to recover from, because we're drawing on it. That time horizon is now gone, and we're not putting money into it anymore. So segmenting our money to do different things for us at different times, that's what the buckets are. In our opinion, there's two major buckets. You've got your cash, that's kind of your emergency cash reserve, but the two major investment buckets are your income safety bucket and then your growth bucket. We want to have good growth, and we want to have long-term growth, and that's really the stock market and tools within the stock market that are going to provide better returns over time. but we don't want to have to rely on the stock market for our monthly paycheck, right? That's why we allocate some of that money towards a safer bucket that is not correlated to what the stock market is doing, that has protections in place that we can't lose money here. And also, it's going to make us a decent rate of return, bond-like return, or better than the bond market without the risk of the bond market. So that now, when we do retire and we do walk into a market downturn, well, yeah, we may lose some money in the growth bucket, but our spending money is preserved for a significant period of time. So we're taking our withdrawals from that safety bucket. And now what we've done is we bought time for the growth or the stock market to recover. And so to us, that's really important to kind of optimize our investment strategy, but also just make it so that we're not so stressed about the market every single day. And so that is something I think is what we coach on. We've done several podcasts on, and we know it works very well. We see the successes of it all the time. Is it the plan that's going to make you hundreds of percent, or very extreme high rates of returns in the 20s and 30s and 40s? You may have a year like that here and there, but that was for your 20s, 30s, and 40s, is to make those types of rates of return because you could handle that risk. When we go into post-retirement and spending that money, we want to grow, but we also want to grow within reason so that we're not uncomfortable with the amount of risk that we're taking. So, Rayton, I know you were talking about some stories that you've got with clients that have kind of gone through this, and let's talk a little bit about that.
Yeah, real quick on this one, is that we had a client. He came to us before he was a client in 2007. Now, if you remember, 2007 was the top of the big housing boom, and when he came to us, he had retired from a company that he had an executive pension, and he had a base pension, and he had his Social Security was going to be starting. So pretty much he said, hey, this sizable 401k, that's not for me. That's for the kids. I don't need it. I've got more money coming in than I can spend. Well, then came 2008. By the way, I'm sorry, he did become a client, and we did have a lot of conversations with him. And we did decide that we would still do this bucket strategy. We would still put some money in places to keep him secure and safe and be able to manage the risk. And then after becoming a client, 2008 hit, the market dropped considerably. Then came 2009, and the company that he retired from filed bankruptcy. And when they filed bankruptcy, he lost his executive pension. The base pension was covered by the federal government. The executive pension was not. So he was back in the office saying, hey, I'm going to lose my executive pension. We got to come up with an income plan now, because now I don't have enough coming in. And I just wanted you to visualize, how happy do you think he was that we had put protection and risk management on that sizable 401k? And really, who got affected here in this deal? Really, the beneficiaries. They're not going to get as much, but they didn't care. That wasn't their plan. The parents' plan was that they just needed to have a good plan in place. And the kids, by the way, we know them still today. They were happy that mom and dad had a good retirement. So that is the power of how we would shift pre-retirement to during retirement. And just to wrap things up here real quick, Merce, if you just want to let folks know here in the last couple minutes, what it is that they need to make sure they've got in place so that they understand exactly what they've got.
Yeah. So bringing this full circle, how do we put this into action? Well, everything that we do and we believe starts with this idea of a retirement-focused financial plan. Whether you're 10 years out for retirement, 5 years out, or you're already retired, we believe everyone should have a retirement-focused financial plan. What goes into that is understanding everything about your financial life, from your income sources like Social Securities and pensions and maybe rental income, to how you're going to spend, to when you're going to retire, to the assets that you've built up. And then we are able to run simulations all the way out, including some of the fun stuff, travel or second homes or legacy money, giving away money, all those different things are built into the plan. And that really shows us the health of the plan. What happens next then, once we agree that the plan is on the right track or the roadmap is looking good, well, then we go talk about risk and have an evaluation of risk to understand how much risk you can handle, which then takes us into the buckets of how much do we need to allocate to each of these buckets of growth and income and safety, for two reasons. One, to control risk to your liking, as well as to be able to withdraw as we need from a safe, reliable, and predictable place. So at the end of the day, that whole thing becomes what we call the peace of mind pathway, which starts with the roadmap. Then we go and implement that roadmap and the strategies behind it. And then the biggest piece of that is we nurture it with annual financial plan strategy meetings, as well as annual tax strategy meetings to make sure that everything is staying as efficient as possible for you.
All right. If any of this you would want to ever have a conversation, feel free to reach out to us. You can go to our website, pomwealth.net, go to the contact us page, and you will be able to get in touch with us. We would love to be able to have a conversation with you if that's what you would like to do. But I do want to close with this. Thank you so much for listening. We look forward to talking to you again next Monday. We hope you have enjoyed this episode of Secure Your Retirement. If you would like to learn more, we have actually created an online course called 3 Keys to Secure Your Retirement. This video course helps you to think through all the different steps as you get ready to plan for and live throughout retirement. You can access this by going to our website, pomwealth.net. In addition, you can also subscribe below to our podcast called Secure Your Retirement.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.